Hi there, Shingirai here again with another update on portfolio performance over the past week. On a one-week basis, we'll see 8 out of 10 of the CBAM portfolios outperform their respective benchmarks as global equity and fixed income markets rebounded sharply on a risk-on week, which would see returns ranging from 0.94% for CBAM 5v2 down to 0.68% for CBAM portfolio number 2. We saw some encouraging data metrics coming out of a lot of places around the globe, which would see Euro government bonds up about 1.88%, alongside European smaller companies really giving that market cap premium and recovering 1.86% on the back of a positive CPI reading for inflation in the Eurozone coming in below expectations. That would also see Fidelity US equity up 1.84%, alongside a strong US jobs recovery towards the back end of the past week. But then we do continue to see some headwinds there for Bailey Gifford China, and alongside large cap European equity, obviously we did touch on earlier, the smaller cap European positions giving a bit more market cap premium in that recovery week, alongside some strain we saw for M&G emerging markets bonds on the back of some concerns around growth and some mixed data coming out of PMI Purchasing Managers Index. In terms of quarter-to-date performance, 2 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from minus 1.11% for CBAM 1v2 up to 0.55% for CBAM portfolio number 5. As I've been highlighting the past couple of weeks, we do continue to see that rally in performance in terms of Japanese equity, and I would see both the JP Morgan and Fidelity positions as one of our top two performers despite some strengthening of the yen that we've seen as a headwind coming into a fresh week, as well as some expiry of futures options, which would cause a natural sell-off of Japanese equity. We also saw a strong rebound for the S&P 500, but largely concentrated to a couple of mega cap tech names, but also that was given a bit of backwind as well, about 1% push from a weakening of the US dollar versus sterling. In terms of Chinese performance, we've been highlighting over the past couple of weeks and months that there have been significant headwinds for Chinese reopening, and that would see all 3 of our Chinese equity positions down 10.15%, despite a 4% rally we saw towards the end of last week, and also a rally we saw trading on Tuesday on the back of some weaker than expected trade balance data, which would really spur markets to begin to make bets on a bit more fiscal stimulus coming from Beijing, alongside Beijing ordering a lot of the local banks in China to lower their lending rates, which is also hopefully really levered towards stimulating the economy from a monetary point of view. Coming into the next 2 weeks, we do see central bank meetings for the Fed in the United States, the ECB in Europe, and also the Bank of England in the United Kingdom, where we get to begin to see some sort of monetary policy path in terms of the ongoing fight for central bankers against inflation.